Hello, everyone. It is a great pleasure to be speaking to you today. My name is Birgit Schulz, and I head up a team at S&P Global that produces our short-term fertilizer outlooks. So in the time that I have today, I'm going to look at certain recent developments for fertilizers, some of which have media attention and some which don't. And then I'll run through our short-term expectations for nitrogen, phosphates, and potash. I've chosen to do it this way to avoid repetition in the outlook sections, because some of these recent developments are actually sort of overarching themes for fertilizer markets. So let's run through some recent developments and the impact those that impact all fertilizer markets. I will say at this point that due to the limited time today, I have made a selection for these developments. So this chart shows what has happened with fertilizer prices since January 2022. It shows prices for urea, the largest selling nitrogen fertilizer, for DAP, the largest selling phosphate fertilizer, and myriad of potash, or MOP, otherwise known as potassium chloride, which is the largest selling potassium fertilizer. We have also added ammonia and nitrates prices to this. Can you hear me okay? Okay, thank you. Onto it, we have superimposed some key events that have occurred over this timeline. There are three key points to note from this chart. Firstly, for all the global price benchmarks we follow, the second and third quarters of 2022 saw either new all-time record prices set or prices getting very close to previous records. So in any context, pricing has been genuinely super high. The second point to make is that whilst the horrendous war that is going on in your country supercharged the situation, prices were already very high before the war started. Any commentary that suggests that high fertilizer prices are quote unquote because of the war, therefore significantly oversimplifies a complicated dynamic. Lastly, as a much admired former colleague of ours used to frequently observe, the cure for high prices is high prices. From those peaks in 2022, prices have come down, though not necessarily to the levels seen before the pandemic and its aftermath. One story that has been attracting attention has been the Houthi attacks on shipping in the Red Sea, which saw the eventual sinking of the MV Rubimar. Our maritime and trade team tracks global dry bulk shipping in real time. Whilst the cargo categorization might not be correct in all circumstances, we are very confident that it is a consistent data set and the trends it describes are real. The data shows that year-on-year dry bulk trade in fertilizers to the end of February this year is showing a 5% increase over 2023. Shipments this year to end February totaled 28.1 million tons, compared with 25.8 million tons in 2023. So we can safely conclude that the Houthi actions are not suppressing total trade in fertilizers. However, through most of last year, roughly 25% of monthly trade would transit through the Bab el-Mandeb Strait. As the bottom graph shows, this dropped down to 16% in January and only 13% in February, and that trend has actually continued in March and April. So it's clear that shippers are using other routes where at all possible. Most of the February trade relates to exports east out of Egypt and Jordan, where they don't have a choice. Shipping costs will have risen. Shippers who continue to ship through the Red Sea tell us insurance costs have risen tenfold, and clearly not using the Red Sea will add time and therefore cost for others. This increase in logistics cost is not reflected in fertilizer prices, however. And that means that the supply side remains sufficiently competitive that the additional costs are being absorbed in supplier margins. We don't expect that to change for however long this issue continues. Now, another thing is, weather and climate. So climate change is an increasing threat to established agricultural practices. 2023 saw an El Niño cycle established in the Pacific. The map here highlights the impact of El Niño on rainfall, and the pattern is broadly similar for temperatures. That means those areas which are frequently prone to drought may also see higher temperatures. The good news is that the impact of this El Niño cycle seems to have been moderate. Rainfall levels in Southern Africa, Australia, and Southeast Asia, especially in the planting and germination months in November and December, were comparatively normal, with the remaining risk being any abnormally high temperatures before harvest. Consensus forecasts predict that the cycle will end during Q3 2024. And we therefore don't expect El Niño to significantly impact yields and harvests in areas frequently impacted by it, which equally means, though, that we don't expect it to have an upward impact on crop and food prices. Outside the realms of El Niño, climate change is adding increasing volatility to weather patterns, obviously. Over 2023, fertilizer affordability has improved significantly for farmers. In the chart on the left, we have a fertilizer index in black and a crop index in red. Both are indexed to January 2010. The fertilizer index comprises the prices for urea, DAP, and MOP as the largest selling nitrogen, phosphate, and potash fertilizers, respectively. The crop index comprises the Chicago Board of Trade prices for corn, wheat, rice, and soya. That is saying it is a basket of the largest selling cereals and oilseeds. The chart is a simple visual aid, where when the crop index is above the fertilizer index, fertilizers are relatively more affordable and vice versa. The chart on the right shows the difference between the indexes, with fertilizers more affordable when above the gray line and less affordable when below. These charts show just how unusual 2021 and 2022 were. With affordability now back in relatively normal territory, we would expect demand in 2024 to be relatively strong, at least based on pricing fundamentals. However, issues such as the weather may have an impact. We know, for instance, that the abnormally wet February in Northwest Europe has slowed farmer field preparation, for example. And these super high prices might have encouraged more farmers to consider switching to, for instance, regenerative practices, although we have yet to see any evidence of that. Now, there are also other topics that can be important on a global scale, like China's export policy and India's position in the global fertilizer market. But with the limited time we have, I'll now move on to the outlooks for N, P, and K. So let me start with nitrogen. Nitrogen fertilizer production starts with ammonia, and much ammonia costs is attributed to the cost of the hydrocarbon feedstock used to produce it. So what's been happening to feedstock costs? And in that context, Europe is an important nitrogen price setter, and therefore European gas costs are an important global benchmark for the nitrogen industry at the moment. At the end of December 2023, the S&P Global Gas team assessed European gas storage fill at 85%. This is 12% higher than historical averages between 2019 and 2022. The most recent storage levels suggest a less volatile price environment. certainly compared to 2021 and 2022. Shortages were experienced in those 2 years after the reduction of gas supplies from Russia. Since then, Europe has taken steps to prevent a similar situation in the future. European countries have largely achieved equilibrium in the natural gas markets, as the gas consumption has decreased by 15%, and the decline in demand from industrial use and gas-fired power generation has contributed to this decline. And they have also established an LNG liquefaction infrastructure where the capacity has increased by 20% compared to 2020. Well, undoubtedly, sort of weak demand for LNG from China and other Asian countries has significantly helped reduce world prices. I personally do not profess to be an expert in gas price forecasting. The current S&P Global TTF price is shown on this slide in the chart on the right-hand side. In broad terms, to the end of 2026, we are expecting gas to be in the US, so this is all in US dollars, $7 to $14 per MMBTU range, with seasonal highs in late autumn and early winter. The risk to the forecast is on the high side if there's any unexpected restriction on supply. So what do we expect for nitrogen prices? Ammonia is the key intermediate for making downstream nitrogen fertilizers, ammoniated phosphates and NPKs. The fluctuations in ammonia prices going forward are mostly based on the supply-demand fundamentals in those fertilizer markets. The disruptions in the Red Sea have had two impacts on ammonia. Insurance costs mean ammonia vessels have opted to take other routes, extending supply chains. Currently, there is little or no spot trade from the West or Eastern product due to the issues in the Red Sea. This means that in the West, those fertilizer producers that are dependent on imported ammonia for production have had more limited supply options. Secondly, with the issues in the Red Sea, chartering chemical tankers has been very problematic, which also means that phosphoric acid supplies from Jordan to India have decreased. And ammonia is used with phosphoric acid to make phosphates. Therefore, if they have reduced phosphoric acid availability, demand for ammonia is also reduced. Let's move on to urea. Ammonia follows urea, typically around 6 or 7 weeks behind. Urea has recently shown some seasonal weakness in Q1, and prices overall have reset due to the significant increase in global capacity over the last few years. This has taken some time to be absorbed, but that process has largely stabilized now, and we are expecting more stability of prices through the next 12 to 18 months, although seasonal patterns obviously apply. The key watch out here for urea is China. Should China relax its urea export conditions, then this would increase the predicted supply and prices would fall, at least temporarily. Indian overall demand will be higher, but so is their domestic production. And therefore, India is less important to world trade than it used to be. With ammonia prices now more affordable, nitrate production has also become more settled after the terrible hiatus seen through 2022. Nitrate prices tend to rise seasonally through the Northern Hemisphere application season, then readjust downward in the second half of Q3, and then very slowly begin to strengthen again. With the fundamentals reasserted, we are expecting this pattern to have resumed now in 2024 with, as you can see on the chart, prices moving in a relatively narrow range in the forecast period. You mentioned sort of in your scope that there was also an interest in a little bit information on low carbon ammonia. So I've added this very briefly to the presentation and hoping that this will be of interest to you in this area at the moment. This slide provides an overview of those ammonia projects that are currently included in our supply forecast until 2026. More projects have been announced, but these are the ones where we believe those are actually going to come on stream. This includes projects in low carbon ammonia, which are highlighted in the green and blue color respectively for green and blue ammonia, and then as well gray ammonia projects, which are coincidentally highlighted in purple here because the background is gray. There are currently around 3.4 million tons of green ammonia expected to come on stream until the end of 2026, and another 2.3 million tons of blue ammonia. And just by comparison, the total expected gray ammonia capacity added by the end of 2026 is close to 9.5 million tons. But I won't spend too much time on this page by reading the projects out to you, but this is included in the deck for your reference, and I will distribute the deck happily to you if that is of any help. So let's move on to phosphates. Phosphate demand has recovered overall. This chart, which is in 1,000 tons P2O5, shows that in 2023, volumes bounced back from the reductions seen due to very high prices experienced in 2022. And we expect that demand growth to continue at a more modest pace through 2024. It is important to note, though, that over the last 10 years, the nature of phosphate trading has changed. In blunt terms, there is less of it. Most of the major producers from Russia, North America, and North Africa have acquired distribution assets in key markets such as America, Brazil, and Europe, which means they are sending material to their warehouses. So this is not third-party trade anymore. And then they're selling from that stock. Major economic shocks aside, this does bring more stability to prices. In this context, India is a very important price-setting market with pricing adjustments based on subsidy settlements and the overall global supply-demand balance. China remains a swing factor in the supply-demand balance, with the ability to come into the market with significant volumes and equally removing volumes, tightening the market. This provides some counterbalance to the point made about the major Russian, North American, and North African producers having warehousing, which can stabilize prices. China has the ability to change that. This is illustrated in the chart on the left, where we have the import requirement for DAP and MAP in yellow, and the export availability in blue, with the Chinese availability split out in the lighter blue greenish color. You can see the majority of Chinese availability is concentrated in the month of May through October. The Chinese allocation or quota is 6.5 million tons. And in practice, much of this will be delivered during this May through October window. The purple line in the graph is the balance. And you can see that in late Q3 and into Q4, this loosens as the impact of this availability takes hold, but then tightens again as China reduces exports. You can see, though, from the price chart on the right-hand side, that overall we are expecting reasonable price stability in phosphates going forward. There will be some weakness in the market mid-year, as demand drops off in the Northern Hemisphere and the availability of Chinese tons has an impact. But this should recover towards the year end as Chinese availability reduces and the market starts building inventories for spring 2025. Excuse me. Overall, the market is reasonably balanced at present, and therefore the main risk to this forecast is a major geopolitical event causing disruptions to supply chains. Now on to potash. Late March and April has seen more stability for potash markets and benchmarks, but nitrogen and phosphate prices were declining. The probability of any significant strengthening for potash at the moment is low. Conflicts in the Middle East, particularly Houthi attacks on shipping in the Red Sea, those continue to impact shipping transiting through the Suez Canal and the Red Sea. Potash dry bulk trade through the Red Sea averaged 525,000 tons per month through Q1, which is lower than in the prior 2 quarters. Cumulative dry bulk trade for potash is significantly higher in Q1 2024, though, than in the previous years. To the end of March, cumulative dry bulk trade was 9.7 million tons, up 28% over 2023 and up 13% over 2022. Whilst this is not necessarily a linear proxy for demand, it is supportive of the expectation that with more competitive prices, potash demand will be higher in 2024 than in the prior 2 years. The weather continues to add uncertainty, though. In Northern and Western Europe, sort of in a belt running from the UK through Benelux, Denmark, Northern France, Germany, and Poland, a very wet winter and cool March and April has hampered application and sowing. It is not yet clear to us how much the weather has impacted application, but there is now an expectation in this area that yields will be reduced in 2024 as some planting has been washed out and others are slow to establish. The forecast for potash shown in this chart on the right-hand side of this page is possibly the most unexciting forecast I have ever presented, but the outlook is in fact for relatively stable prices. The overall level of trade for potash suggests that the supply side has provided a reasonably strong seasonal demand in the Northern Hemisphere. Lackluster pricing should suggest that there remains sufficient material to meet demand, and any recent slight uptick in individual CFR benchmarks is more likely to reflect shippers trying to claw back some of the increases in freight costs on routes trying to avoid the Red Sea in a generally balanced market than it is anything to reflect a market developing real tightness. Looking forward, we are expecting any settlements for CFR India and CFR China to set the tone for the middle of the year. It is probable that the CFR India price will settle first, with voices actually heard this week that the price was settled at $280 to $283 per ton CFR India. The official confirmation is yet pending. This would be below the current $319 a ton, and if that settlement in the range of $280 to $283 a ton CFR India would come into effect, it would imply a settling of the CFR China price at around $275 to $278 a ton CFR China before any volume discounts. The main structural risk to this forecast is to the upside, with the potential for much stronger than forecast demand tightening the balance and resulting in a sharp uptick in prices. So I've reached the end of my presentation. I hope you found this valuable and helpful, and thank you very much for the opportunity to speak to you today.